from the narrative out there, you would think that every central bank is selling Treasury securities and that the dollar's day is done. And from this chart, you can see that's just not true. There have been some sales. We know both China and India have been selling, but for the most part, and they have been a drag on the growth rate here. But for the most part, the Treasury securities held abroad are still increasing.
For years, investors have been told that America's debt is spiraling out of control, inflation will stay elevated for years, the dollar is losing its dominance, and the economy is headed toward a painful reckoning. Those concerns have shaped everything from interest rate expectations to investment decisions. But what if many of those assumptions are built on outdated comparisons and incomplete data? Few investors have challenged conventional thinking as consistently as Cathie Wood, founder and CEO of ARK Invest. Whether she's discussing innovation, monetary policy, or the future of the global economy, Wood often builds her outlook by connecting long-term macro trends with structural technological change. In her latest market update, she argues that many of today's most widely accepted fears simply don't match what the data is actually showing. Before we hear Cathie Wood's analysis, take a second to support the channel. If you enjoy thoughtful macroeconomic and crypto market coverage backed by expert insights, please give this video a like, subscribe if you're new, and turn on post notifications so you never miss our latest uploads. Now, here's why Cathie Wood believes investors may be looking at the U.S. economy through the wrong lens.
Here, we're starting with fiscal policy. And you can see, as usual, deficit relative to GDP. The green line there is where Treasury Secretary Bessent is aiming to take the deficit by the end of 28, or at least fiscal 28, so September of 28. We think that he and this administration will achieve a much lower deficit because growth is going to be much stronger, we think, than is in most forecasts, including the government's own forecasts. So on the next slide, want to continue here with fiscal policy. Here is a chart. The green line is debt, government debt relative to GDP. So it's over 100%. And that has many people very concerned. Now, you can look at the purple line, and that's debt relative to equities in the United States. And you can see that is on a downslope. We like to think of equities as representing wealth out there, so debt relative to wealth going down. Nonetheless, as I was traveling around, this debt to GDP ratio has been getting a lot of press, mostly because people think that interest rates and inflation are going to be stuck at these levels for a very long period of time because the debt seems intractable. And we can only bail ourselves out of this problem by inflating it away. We disagree entirely. We're not as alarmed by this number. We do think that as this government focuses on getting that deficit down, that debt relative to GDP will start to come down again, especially if we are right that growth is going to surprise significantly on the high side of expectations. So here I wanted to take a look at both fiscal and monetary policy in a single glance to show the contrast between today, now that we have pretty much, we are on the other side of the COVID boom bust, and the 60s and 70s. And you can see how different it was back then. The purple line was federal outlays, and you can see what so-called guns and butter did back then. Guns, we were in the Vietnam War, so defense spending was booming. And guns and butter, the social programs that were put in place back then, all ballooned government spending. And you can see from the green line, while it didn't accommodate it altogether, over time, money growth accelerated and really by the late 70s was accommodating all of this spending. And it was an intractable problem until Volcker came in the early 80s, late 70s, early 80s, and just slammed on the brakes. And you can see he slammed on the brakes, and he kept, anytime inflation fears were reviving, he slammed on the brakes again. So money growth did slow down quite significantly. So that's some of the history. You can see why so many people were afraid that we were going back into that environment. And it was because of what happened during COVID, and also because of 0809, trying to get out of that mess and then having to deal with COVID. So these are very long-term in terms of their 4-year annualized rates of change. So you can see we're on the other side, and federal outlays, while they have picked up recently, defense, a big reason for that. They are still, from a growth rate point of view, on a 4-year moving average basis, still near the lower end of where they have been in this chart's history, as is money growth. So we believe that fiscal and monetary policy, after, the shocks of 0809 and COVID, that we have reset and we are in a good place, and that fears about debt as a percent of GDP continuing to climb are misplaced.
Cathie Wood's argument isn't that America's debt suddenly doesn't matter. Instead, she believes investors are focusing on one headline number while overlooking the forces that ultimately determine whether debt becomes manageable or dangerous. In her view, stronger economic growth, improving productivity, and tighter fiscal discipline could change the trajectory of debt much faster than many economists currently expect. She also argues that today's monetary environment bears little resemblance to the inflationary backdrop of the 1970s, making many historical comparisons misleading. But perhaps her most controversial view comes next. While headlines continue to warn about de-dollarization and the decline of American exceptionalism, Wood believes the evidence points in the opposite direction. She explains why she remains bullish on the US dollar and why innovation could become America's greatest economic advantage over the coming years.
From the narrative out there, you would think that every central bank is selling Treasury securities, and that the dollar's day is done. And from this chart, you can see that's just not true. There have been some sales. We know both China and India have been selling, but for the most part, and they have been a drag on the growth rate here. But for the most part, the Treasury securities held abroad are still increasing. So we wanted to put that in perspective, because last time around, you saw we showed a chart that where Turkey was basically out of Treasury bills. It had been supporting its currency by selling Treasury bills and taking the dollars and buying Turkish lira. So we see that currencies around the world, Japan and Korea, I mentioned before, those currencies, I think Japan's is at a 40-year low, at roughly 162 yen per dollar. And so they're probably going to take some more concerted action. We had seen that Japan, I think in April, had sold, I think, $76 billion worth of Treasury bills, attempting to support its currency. It wasn't enough. It went out to an all-time low. So we do hear that narrative, but I wanted to present this chart because there's not a wholesale disgorgement of U.S. Treasury securities. So on the next chart, we will focus on the dollar, and you can see this is our Cathie chart. How high will the dollar get this year? And you can see the number is 1049, and it was higher before today's employment report. And we'll get into the employment report in a moment, but it was much softer than expected in many ways. And so the dollar predictions went down in terms of the level because I believe most of the tightening moves have been taken out of forecasts, and most people think that higher interest rates support the dollar, which is true. The dollar does attract more buyers when interest rates here are higher. But if you'll notice, you can't see it on this chart. You'll see it on the next chart. The dollar is actually at, today, this was yesterday's number, today it's at about 100.5, somewhere in that range. So the betting is that the dollar is going to go up, at least Cathie's prediction markets think so. And we would agree with that. And for a couple of reasons. I've been saying for some time that fiscal policy, so the deregulation and massive tax cuts, especially for corporations that we've seen over the last year, are beginning to increase the return on invested capital in the United States relative to that abroad. There's another thing that's become very obvious, and we saw it with SpaceX's debut in the public markets, but which created many, many millionaires and 100 millionaires. The return on invested capital is higher here, and the return on labor is higher here. The kind of incentives for innovation in this country are like nowhere else in the world. And so I think that's becoming very obvious. And of course, OpenAI and Anthropic are soon to follow, and that will be the same story all over again. So we think we are dollar positive, as I've mentioned on many calls. I know that's not the narrative out there. And in fact, the end of American exceptionalism is, we think, greatly exaggerated. SpaceX, OpenAI, and Anthropic, very important cases in point.
Cathie Wood's broader message is that investors should be careful not to confuse popular narratives with economic reality. Markets often become dominated by stories that sound convincing, but history repeatedly shows that consensus can be wrong when the underlying fundamentals begin to shift. Her presentation challenges viewers to look beyond headlines and focus instead on productivity, innovation, and long-term economic trends. A major pillar of her outlook is the belief that technological innovation is becoming an increasingly powerful economic force. Companies developing artificial intelligence, aerospace technologies, robotics, and other breakthrough industries have the potential, in her view, to increase productivity across the economy, improve returns on capital, and support stronger long-term growth. If those trends continue, they could reshape many of today's assumptions about government debt, inflation, and economic resilience. Her optimism about the dollar follows the same logic. Rather than expecting capital to permanently flow away from the United States, Wood believes investors will continue to favor markets that offer the strongest innovation ecosystem, the highest returns on investment, and the greatest opportunities for wealth creation. Whether that ultimately proves correct will depend on how these structural trends unfold over the next several years. But it stands in sharp contrast to the prevailing narrative surrounding America's economic future. As always, no single forecast is guaranteed to play out exactly as expected, and the coming years will undoubtedly test many competing macroeconomic views. But hearing thoughtful arguments from experienced investors helps us better understand the forces shaping global markets and prepare for multiple possible outcomes. We'd love to hear your perspective. Do you agree with Cathie Wood that fears surrounding U.S. debt and the dollar have been overstated, or do you think the risks are still being underestimated? If you enjoyed this breakdown, please leave a like, subscribe to the channel, and turn on post notifications so you never miss our latest market analysis and expert interviews. Share your thoughts in the comments below. We read every one of them. Thanks so much for watching, and we'll see you in the next video.